Hello and welcome to AI Market News by LM. Before we jump into today's deep dive, we need to read the following disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, so we are diving deep into Thursday, October 16th, 2025. And looking at the headlines today, it feels like the market isn't just conflicted, it's like genuinely split. You've got the AI giants on one side, just, posting these amazing profits, really proving the bull case. But then on the other side, the sort of foundational economy looks like it might be hitting the brakes hard.
Exactly, and the sheer volume of information coming in right now, from geopolitics to these, frankly, surprising data points, it can feel overwhelming. So our mission here in this deep dive is really to take the prepared resources and synthesize them. We want a concise, structured analysis, and we're focusing on that core conflict, this explosive growth of the future economy, AI and tech, battling what seems like a sudden slowdown in the present. We'll dig into key U.S. equities, macro indicators, and those global currency cross currents to make sure everyone walks away well-informed for, what looks like a pretty volatile session ahead.
Okay, let's unpack this, starting with, the biggest driver of optimism today, TSMC, Taiwan Semiconductor. They're essential, right? The foundry for all the high-end chips. They just reported a massive 39% surge in Q3 profits. That's not just good news. It feels like confirmation that this AI megatrend is really firing on all cylinders.
Right. And what's really critical here isn't just that they beat earnings, though that's obviously good. It's the forward conviction. TSMC is, like you said, the ultimate bellwether. And they hiked their 2025 revenue growth projection, hiked it to the mid 30% range. Now, that is a loud signal to the entire supply chain. It suggests just sustained, almost insatiable demand for the chips used by, their core customers like NVIDIA and Apple.
And the market's reacting pretty much exactly as you'd expect, right? NASDAQ 100 futures ticked higher immediately. But the question then becomes, with that kind of aggressive projection, can TSMC actually execute on growth that high? Doesn't that bring in, significant execution risk? Maybe some over-optimism?
Well, the sources suggest that risk is maybe mitigated by visibility, because the demand is coming from these huge long-term projects, building out data centers, new infrastructure. They probably have better forward sight than most companies. So the market seems to be pricing this as supply certainty, not just some temporary surge. It definitely strengthens the whole bullish case for tech.
Okay, now if we want to talk about a complete contrast, let's pivot from that high-flying tech growth to a classic economy paradox, Nestlé. While TSMC is investing heavily for growth, Nestlé's new CEO just announced some pretty aggressive cost cutting. We're talking 16,000 jobs being cut. That's about 6% of their global workforce. And they've boosted their cost-saving target to 3 billion Swiss francs by the end of 2027.
Yeah, and this is where the market's, let's say, ruthless efficiency becomes really apparent. The stock surged 8.9% on the news, its largest gain since 2008.
Wow.
Right. So the paradox is investors strongly approve of the company, basically extracting value, getting lean because of competitive pressures. They're rewarding shareholder returns over, employment security. It really highlights the difference, doesn't it, between the capital-intensive growth strategies of AI and these value extraction strategies of, old-line consumer goods companies.
That comparison really sets up the volatility we're seeing elsewhere, like in the AI talent market itself. Shifting from value extraction back to high-stakes value capture. We saw Apple's head of their ChatGPT-like search effort just left for Meta. It's just a stark reminder, isn't it, that the talent war is incredibly real, and companies like Meta are willing to spend enormous sums to get that top-tier AI expertise, which of course drives up costs across the whole sector.
Oh, absolutely. It's a clear sign of the internal stress within the sector. And, to kind of ground all this AI euphoria, we have to look at the skepticism coming from some major figures too. Citadel founder Ken Griffin stated pretty explicitly that generative AI isn't currently helping hedge funds produce market-beating returns. He called it a limited tool for finding alpha.
That's interesting.
It is. It's a crucial distinction, right? The infrastructure, the chips, that's booming. But the immediate practical revenue-generating application of the actual alpha that might still be lagging outside of the companies selling the shovels, so to speak.
Okay, let's turn now to the broader macro landscape, because this is really where the conflict with that AI optimism gets, heated. Despite those positive tech futures, recent trading has been marked by what the sources called very choppy sessions.
Yeah, if we take a quick snapshot of yesterday's closes, Dow Jones barely down 0.04%, S&P 500 up 0.4%, and NASDAQ led up 0.66%. But what's really interesting is the market calm, or maybe the illusion of calm. The VIX, a volatility measure, is currently sitting around 19.94. That's down about 3.4%.
Right.
This relative calmness just doesn't seem to quite match the underlying economic shock we actually saw this morning.
You're talking about that significant data miss this morning, October 16th, 8:30 a.m. Eastern. The Philadelphia Fed Manufacturing Index, the forecast was looking for 23.2, I think.
Yeah.
And the actual reading came in dramatically lower, 8.6. That's not a marginal softening. That feels like a genuine air pocket in manufacturing.
It really does. That kind of deviation just screams slowdown. And the narrative that was already being established by the Beige Book, which confirmed that trend of gradual slowing in the U.S. economy, it just got a huge push forward from this Philly number. The Fed's dual mandate is definitely under pressure, and you can see the market reacting to the weakness.
But hang on, the data isn't uniformly weak, is it? We did see some resilience somewhere else. The NAHB Housing Market Index, that came out at 10:30 a.m. ET. It actually came in slightly above forecast, 33 versus an expected 32.
True.
It's a minor beat, sure, but it does keep the no landing or soft landing camps supplied with a little bit of evidence.
It absolutely creates dissonance. But when we connect this overall softening picture, especially that Philly Fed miss, to the policy outlook using the CME FedWatch tool, we see the market is clearly prioritizing the manufacturing weakness right now. There are significantly increased bets pricing in a 50 basis point cut from the Fed this year.
50 points, wow.
50 points. The market is effectively saying, look, the economy is slowing faster than the Fed is maybe acknowledging, and they will be forced to pivot.
So sentiment is obviously a huge driver here. Let's look at the CNN Fear and Greed Index. Given this massive conflict, we're talking about AI booming, manufacturing maybe crashing, VIX relatively calm.
Yeah.
What's the index telling us about the real balance of risk out there today?
Well, it's telling us there's actually a surprising degree of maybe complacency baked into the system right now. Remember, the index uses those 7 equally weighted indicators, everything from momentum to breadth to options activity to gauge market emotion, 0 to 100. And while the market has been choppy, the overall reading suggests that kind of internally investors aren't deploying enough fear just yet.
Okay.
This is often the state just before sharp volatility returns. It feels like the AI confidence is overriding some legitimate concerns signaled by that manufacturing data and also by the bond markets, which are already showing some flight to safety behavior.
Okay. Moving to global markets then, the dollar weakness theme seems to be dominating Forex today. The U.S. dollar index is currently weaker, trading around 98.390, down about 0.15%.
Yeah, and that dollar weakness ties directly back to the macro data we were just discussing. If the market's pricing in 50 basis points of cuts this year, the dollar is naturally going to soften against its counterparts. We see this clearly in the EUR-USD pair. It's currently at 1.1653. That marks the third straight day of euro strength against the dollar.
And looking east, USD JPY is trading near 151.24. ONDA's currency strength chart confirms the Japanese yen is broadly weaker against majors today. Why is the yen so vulnerable right now?
Well, the JPY weakness seems intrinsically linked to the ongoing domestic political uncertainty in Japan. There's this situation involving the Ishin party deciding on a potential coalition with Takaichi, and that decision is expected by October 20th. So political instability plus those persistent rate differentials just continues to undermine the yen. Interestingly, the open position data from ONDA for USD JPY shows a pretty mixed short-long distribution. That often just fuels more volatility in that pair.
Okay, shifting to commodities now, we're definitely seeing a clear safe haven demand signal there. Gold hit another new record high this morning. It's just continuing this relentless rise, trading at $4,259.41. Up over 1.3%. Investors are clearly seeking protection.
Absolutely. Meanwhile, oil is showing signs of geopolitical sensitivity as usual. WTI crude is up slightly, around $58.72. That move came after President Trump stated that India's Prime Minister Modi agreed to stop buying Russian oil, at least temporarily. Geopolitics just keeps adding this heavy premium to energy markets.
And speaking of geopolitics, the U.S.-China trade conflict remains highly ambiguous, shall we say. President Trump declared the U.S. and China are in a trade war now, citing tariffs as a necessary defense. Pretty strong words.
Very strong words. Yet, almost simultaneously, we get this conflicting signal from Treasury Secretary Scott Bessent. He actually floated the possibility of extending the current 90-day tariff truce.
Oh!
Yeah, and this really reveals the core bargaining dynamic. The extension, Bessent suggested, would be in return for China delaying or perhaps walking back its rare earth export controls.
Rare earths.
Exactly. So this confirms that the most critical leverage point in this whole trade dispute remains China's dominance over rare earth minerals. And importantly, the deadline for that current truce extension is approaching rapidly.
Okay, so looking ahead to the rest of Thursday, October 16th,
Wow.
we've got a packed schedule of commentary, stuff that could really shift market expectations, especially after that Philly Fed shock this morning.
Yeah, we absolutely need to watch the lineup of Fed speakers closely. In U.S. Eastern Time, we've got Waller, Barr, Bowman, and Kashkari all on deck. Their comments on the labor market, on inflation, they'll be under a huge microscope as the market looks for any reaction to this sudden manufacturing weakness.
And internationally, probably the most important scheduled event is ECB President Christine Lagarde. She speaks at 12:00 p.m. Eastern. We'll definitely be listening for any signals there regarding European economic health, particularly since the euro's been showing strength against the dollar lately.
Right. And for everyone tracking the broader calendar, keep the investing.com economic calendar handy. It really remains the essential place to track all the upcoming events, especially for some of those vital data points that have been subject to external delays, like that overdue BLS report.
Okay, so this brings us to our final, maybe provocative thought for us to consider today. We spent most of this deep dive analyzing the macro slowdown, the signs of weakness that are fueling these rate cut bets. But what if the opposite is actually true underneath?
Well, based on commentary in the sources, there's actually a pretty strong counter-argument building. The idea is that inflation pressures might actually be building beneath the surface. And this isn't necessarily your traditional inflation. We're talking about two specific pressure points kind of cooking under the hood, and interestingly, both are connected back to that AI boom we started with.
Okay, go on.
First, the sheer proliferation of AI data centers is driving significantly higher energy and electricity costs. Just think about the power needed.
Right, makes sense.
Second, we still have continued wage pressure in key sectors, simply because the labor market, despite some softening signs, remains pretty tight overall. So if that AI infrastructure growth really translates into persistently high utility costs for everyone, then the cooling macro picture we're seeing might actually be masking a kind of structural inflation brewing underneath. Which raises a crucial, maybe the ultimate question for the Federal Reserve. Can they really continue to focus solely on the employment side and the slowing economy side of their dual mandate? If this potential AI-driven energy cost inflation accelerates rapidly into, say, 2026, it suggests the AI boom might not just be a stock market driver, but maybe a hidden future inflation driver as well.
Okay, so to summarize today's deep dive then, we basically have the market operating under these two powerful, really opposing forces. You've got the overwhelming confidence and profit expansion in AI and tech, spearheaded by that stellar TSMC forecast. And that's battling against these clear signs of underlying macro weakness like that dramatic Philly Fed miss we saw, which in turn is fueling expectations for Fed rate cuts.
Yeah, the real challenge for investors now, I think, is deciding how long that AI euphoria can successfully override the softening economic signals before volatility truly returns and maybe forces a correction across the broader market.
Thanks for watching. Don't forget to like and subscribe.